Hey everybody, and welcome back to another trading education video. Since today is a holiday in the US and markets are closed, the clear request was for doing a video on using mean reversion to identify spots to sell covered calls. I'm also going to talk about selling puts on the flip side of the market, and we're going to look at that through the lens of assets like MicroStrategy and Tesla. But really, for this strategy to work, you want to pick volatile assets where you can see that mean reversion spike, and you also have a high probability of the price moving up and retracing so you don't get called out if that's not your goal. But there are lots of goals to discuss with this. So in a very basic sense, the way to think about selling a covered call, you can only do it if you own 100 shares of an asset. So if I have 100 shares of Tesla, let's just say, and the price is spiking to the $500 range, and I think that's not sustainable, that's when you want to sell, because there is maximum FOMO in the market. You can really squeeze out a lot of premium, and you pick a date in the future where you're like, it's surely going to be below this price in that future date. And the more time you pick for that future date, the higher the premium. And I'll go over some of my strategies on that as we dive into the charts. So you sell that covered call at a higher price. And if that higher price isn't hit by the time your covered call expires, you get to keep that premium. On the flip side of the market, when things are heading down, you can sell a put. So you're thinking things are bottoming. I'm going to sell this put on whatever the stock is, and you're getting paid to put on that position. If the stock rebounds back up, and by the time that contract expires, the price isn't hit, you get to retain that premium and you don't have to buy the stock. The liability with selling a put is that you have to put up the cost for the eventuality that you may have to buy that stock. So if it's a $100 stock, one contract is 100 shares, you would have to put up $10,000. So that's taking money out of your brokerage. So this gets into your strategy. Right now, I'm not selling a lot of puts because I want to keep my capital and my margin available for other opportunities as the market is really moving up. So talking about the goals of each, if we're selling a covered call, the goal is to earn that premium of selling the covered call, and potentially you would be selling your stock at a higher price. So you just have to be okay with saying, I'm going to let go of this stock at X price if it keeps rallying. And the only real downside for you is that you may not see that extended upside if it runs past that price target. On the flip side, on the way down, it's also the goal to earn premium when you're selling a put, but you potentially have to buy the stock at a discounted rate because you have that premium as well if the price continues to drop. So this is best done when a stock is spiking in an extreme nature to the upside or dropping in an extreme clip to the downside, because we know those kinds of trends aren't sustainable and are most likely going to turn. So that's why we're going to look at mean reversion. I'll also bring in some RSI for confirmation to really give us the best chance of winning with these trades. My personal strategy is built around playing those extreme spikes in the market that we see just a couple of times a year. I'm not selling covered calls often, but I just want to look for those opportunities where I can squeeze juicy premium out of the assets I already have. So one example for me was MicroStrategy in November as we ran up to all-time highs. It was just moving at a clip, and we'll look at it on the chart, where it was clear between mean reversion and just the pattern of a blow off top that this wasn't going to be sustainable. So I sold covered calls for January of 2027 at an $890 strike price. So I would have been happy to part with those shares at an $890 strike price plus the $205 premium per share. Now, I was able to buy those back at the end of December for $35 a contract. Remember, I earned $210 per contract in November. And then just a month later, I was able to buy them back for $35 a contract. So if I'm looking at my overall cost basis on MicroStrategy at being $50, I subtract that from the $210 minus the $35, that gets us to $120 profit. I have basically now been paid $120 per share of MicroStrategy to own and hold that stock. It's a completely risk-free, in the money position for me. And the next contract I sell is just going to be gravy on top of that. A lot of folks don't opt for these long-term covered call sells. I like them because I only want to do this a couple of times a year and I want to get the most juicy premium possible. So that's my basic strategy because I'm not doing this all the time. Other folks are doing it month to month. So they're always selling contracts 2 to 3 weeks out and they're getting a much smaller premium for that, but they're using their existing holdings just to generate cash flow month to month. So that's another strategy you can use. I will get into both timeframes on the charts, the 4-hour, the daily, the weekly. But I found that also the signals are the most clear to me of things being a blow off top when we're on that daily and weekly time frame. So that's the other reason why I like to stick to this strategy. And I'm executing on this 2, maybe 3 times a year, depending on the asset. Okay, getting into the charts, and we'll start here on MicroStrategy. So the first thing I'm looking for to identify these spikes and when to sell covered calls would be a spike on mean reversion. And generally for MicroStrategy, and this applies for Tesla and Bitcoin too, anything above 2 standard deviations overbought, so right there, I'll just draw this line in for clarity, is a point where you really want to pay attention on the daily, and it's a clear sign that we're overheated and this isn't going to last. Now, this is different for every asset, and you can see on the flip side on the bottom how we normally don't really get 2 standard deviations oversold, and we can just compress our timeline here to go back all the way to the 2022 bear market, and you can see even at the bottom of the bear, we didn't really get to 2 standard deviations oversold. We got to 1.74-ish. So if you're looking at doing this more regularly, you would want to identify a zone, and right around here at -0.7, you can see a lot of levels are hitting that on the more extreme sells. So maybe that's your downside target on MicroStrategy. But again, look at your chart and just do this for yourself on each asset you're trading. And for MicroStrategy on this run up, we've had 2 clear spikes above, a third one right here that just touched that 2 standard deviations, and you can see we went there from $46 back down at the bottom to 33. So, like a 25-ish% move. But these big blow off moves right here are really the ones, at least for my strategy, that you want to pay attention to. So we see that in our 2 mean reversion spikes there. And if we just bring up the chart, and let me turn off this Gann swing indicator so we can see the candles more clearly. The other thing I'm just looking at visually is signs of a blow off top. And so moving into the election in the US, MicroStrategy already had more momentum than Bitcoin and other stocks. And you could see this clear trajectory that we had, and we can just draw a little underside trend line right here. And then after the election, as everything was going crazy, you can just see how that clip increased. And a pace like that is not sustainable in markets. So that just visually is your first clue of a blow off top incoming. The next sign of a blow off top is multiple gap opens. So we have our first one here as things really start picking up, and that's getting me to start paying attention. Then we have a second one right here, and here was our big gap up. We gap from the top of that candle to the open of this candle, and this was our big reversal. So these 2 in a row were really a sign to me to get out. And I got very lucky. I sold these on this morning at about $530. I didn't know this was going to be the turnaround day, but that second gap up just told me that, hey, it was time to get out. And that's also partly why I got such a good premium. And so if we're looking at mean reversion, it's starting to spike into this move. And on this first gap up, we're not at that 2 standard deviations yet, but RSI is already really spiked. So that's another thing that's getting me to pay attention. And then here on this next gap up, we are above that 2 standard deviations, and we continue to be in that place. We hadn't printed this third dot yet, but this dot right here was enough for me to execute on that contract, as well as seeing these gap up opens and the RSI on the daily just being spiked like that. Because like with mean reversion, you can see that we don't often get the RSI to sustain in that top part of the range for very long. And then on the flip side, on the way back down, I bought back my contracts down here. Mean reversion on the way down wasn't all the way at the bottom, and neither was RSI, but we had closed this gap fill right here, and I thought we were still in the bull run. I didn't know that we would pull down more here on all the tariff turmoil that we've just been through. So closing this gap fill, even though these signs weren't saying it was necessarily the bottom, was good enough for me, and I was happy enough to buy those back for $35 a contract. And then we rallied away from there a bit, and that was enough confirmation for me. Yeah, sure, I could have maybe bought them back for $22 or $25 a contract down here, maybe less, but we're really splitting hairs at that point. You can see how from that time, I also had that underside support line drawn on the RSI that broke down that we've talked about on Bitcoin and others. This isn't really a signal I'm paying attention to for selling covered calls, because by the time that broke down, we were already 3 days past that move. But the other thing I'm often looking at for confirmation is just going to the weekly time frame. You can see on both these spikes on the way up, the weekly was also very extended, and the weekly RSI was also elevated. So this won't give you quite as precise a point to sell as the daily, but I like to just flip over to this for extra confirmation. And if you go way back on the weekly in 21, there was only one spike above 2 that was really elevated, and one time the weekly RSI got into this overbought territory. So that's extra confirmation for me that this is a great time to sell that covered call. Okay, if we go over to Tesla on the daily time frame here as well, you can see I have that line drawn in as well at the 2 standard deviations overbought right there. And we spiked above it twice on this run up from November into December. And Tesla wasn't quite as clear. If I turn off the Gann swing indicator again and I zoom in, on this first run up, we actually had this gap. I believe that was on earnings, and I can't remember what this one was here. But we had multiple gaps up that made this honestly look like it could be a blow off top, and then we moved into consolidation and had our final blow off top. So this one just on the daily was a little bit trickier to nail the top, because this might already have you thinking that it's time to sell those covered calls. So how do you know that this would have been the peak to sell that covered call and not this one here? Well, this is where I go back to the weekly for confirmation. And if we go to the weekly and we go to that same time frame, right here where we had those gap ups on that week, our mean reversion on the weekly was not close to the top yet. So this was your secondary indicator to tell you, hey, wait just a little bit longer. And this spiked a little too late. So again, you're not looking at this sell signal to sell your covered call. You're looking just to get over that 2 standard deviations, and you can see how it lined up with the week right before our peak. So this can tell you on the weekly, okay, this is when I want to be selling in this range because we're above that. And we go back to the daily, and on the daily, the weekly was telling us to pay attention right here. On the daily, we spike back up, and you got this signal just on the day that was our final top. And we didn't get those clear blow off top signs with Tesla like we did with MicroStrategy. It was running up a bit more steadily, but this is just when a bit of TA comes in. You're of course getting this signal on mean reversion, your RSI is spiked, and then you have this reversal candle. So this one was a little harder to nail to the day exactly, but what you can often do to get the best premium out of this is when you see a reversal candle like this, and we have 3 down days, which is also indicative of a bigger pullback to come, mark that on your charts and just as something to keep in your TA back pocket. When you have, especially after a big run up, 3 red days in a row, that most often leads to more correction. If you look at our 8-month consolidation we had on Bitcoin last year, we had those 3 days. At the peak of Bitcoin in December, going into January, we had 3 down days, and it led to bigger correction. So it's not 100% signal, but it happens often enough that I really pay attention to it. But anyway, back to the ideal time to sell. If you didn't nail this day, then you would wait for the rebound. And you can also see on the cloud how we're rejecting from the inside. And this next update here would be a great time to sell because the premium would most likely be a bit higher on Tesla right there. And if you miss that and you're trying to sell a covered call now on the way down, you will see that the premium is just going away. So the best time to sell is really on the way up. And I would err on the side of maybe not nailing the exact top, but being somewhere in the top third here of the move up, because the premiums will be juicier and you may be kicking yourself for a couple days, but we all know that trends like this aren't sustainable in the long run. So if you have some patience to wait it out, it will eventually work in your benefit. And as this drops, even right here, you could have bought back those contracts for much less than you sold them right there. And if you think the trend is going to continue and you're waiting for mean reversion to buy them back on the way down, you can do that anywhere down in this range. If we look back in time in Tesla just to see how many opportunities we've had at that 2 standard deviations overbought, there aren't many. There's this spike here in November of 2021. And outside of that, this peak right here in November of 2024 was the only other time we've seen that. And now we're starting to head up again. And maybe this will happen one more time this bull run, time will tell. But if you're doing this more month to month, you could draw in another level and you could say, okay, we have all these peaks here at 0.8. So maybe anything above, say 1 would be a level that you want to pay attention to if you're doing this monthly. So let's just draw that in here. And we can see how those work out for us. So you can see that 1 standard deviation on Tesla corresponds to all these peaks here, here, this little one here before we ran down. So if you want to do this more frequently, you can mark up those other levels and just play the strategy of selling the covered call and then buying it back, assuming you're doing that with more time. Or if you're just selling a covered call with an expiry in a couple weeks, and you're not worried about buying it back, that could be your strategy there too. I like sticking to the daily personally. I find on the 4 hour that the signals just aren't quite as clear for me and they don't quite hit the same level all the time. I know some people do trade the 4 hour, but I find personally that I get much more confidence on all these assets sticking on the daily time frame. And the last thing I want to discuss on Tesla, and I'll just make this full screen, is selling puts. And you can sell puts the same way you sell covered calls to generate income. I don't do that as much because, like I said, I don't like having my capital tied up. But what I will often do is I will sell puts at a level that I'm happy to buy the stock at and that I think it's going to in the near term. So on our way down on Tesla, as we broke below that $300 range, I knew I was targeting 280, 250, and then 220 down on the bottom end. And so I sold puts for that 220 strike price. We wicked a little bit below it, but I put a couple contracts in there. And what that allowed me to do, I was saying, I'm happy to buy the stock at 220. I think it's strong support and I'm getting paid a few bucks to do it. So my average cost on each share is now in the low $200 range as opposed to at 220. I also put a couple runners out down here. We were talking a few weeks ago about this undertrending support line that we've had on Tesla for years and years. And things were so tumultuous. I was like, there's a chance things might go down there. And so I just sold some puts as we came back into this range for that 170 to 180 strike price. I think I actually put them at 180 because of this support line right here. And that never filled, but I got to keep the premium and my funds were just tied up for a few weeks because I put that strike price like a month out. So anyway, that's one strategy for puts. I, like I said, don't do it as much, but a lot of people do it successfully and they like doing it. With selling puts, it's nice to do with margin because you're not tying up your actual capital. You're tapping into your margin, but it's in a way phantom margin, so to speak, because no interest is being charged on it. It's just that chunk of your margin is being held for if you have to buy those shares. And then were you to have to buy them on that margin, that's when interest starts kicking in. But for that few weeks where it's held, no interest is charged. So it's a nice way to use margin without having to actually incur any costs for utilizing that margin. Okay, I hope that was helpful to see how I use mean reversion on the daily time frame and then zooming out to the weekly time frame to get confirmation of when I want to sell those long-term covered calls. If you want to use this strategy on smaller time frames, like we said, you absolutely can do that, but you need to identify those levels for each asset. So for Tesla, that was 1 standard deviation overbought. It will vary stock to stock, commodity to commodity. So just go in and back test it in the chart, and I'm sure you can identify that for whatever you're trading. Remember, you're looking for stocks that are volatile. So something that's not having big spikes up and down. not great to trade on this strategy. You want to see those violent moves, and that's how you can really capitalize on this. If you have questions, leave those in the comments down below. I look forward to seeing you all on Friday for the weekly wrap-up. Bye for now. This isn't financial advice. Past results are not indicative of future performance. Do your own research.